Okay, finance after the crisis. I think the actual model for the economics profession is Humpty Dumpty, and if those of you haven't read this children's nursery rhyme for a long, long time, it's time you did again, because Humpty Dumpty is actually a combination of Sharp and Eugene Fama. Is that when I use a word, it means exactly what I want it to mean, neither more nor less. And the final punchline I absolutely love, impenetrability. That's what I say. And that's what finance has been. And it's no wonder. You take a look at the way we define finance. What is an efficient market? Well, that's a noun, and it's a system which is capable of accurate prophecy. If you want to see what prophecy is, look for the word rational, where all agents can predict the future, and any agent can borrow an infinite amount of money. And this is Sharp making precisely those statements back when he first dreamt up this fantasy back in 1964. Of course, he admits they're unrealistic assumptions, but then defends them on a bastardised versions of Milton Friedman's appeal about assumptions not mattering. Number two, if you want to see why I say it's about accurate prophecy, in the paper I mentioned in discussion, where Sharp, Fama and French both say the theory has been disproven, they point out that what Sharp was assuming is not only do agents agree about the future, they're right about the future. So we have a model of finance assuming people can predict the future. That's great. Expected value, what's that? Well, that's what you won't get in a one-off gamble, and it's what your lecturer actually says the gamble is worth, and therefore it's the right answer in a multiple choice question, but it's total nonsense if you believe it. Rational means the ability to predict the future course of complex systems, and you've got to look at prophetic and see Nostradamus to understand what that means. And for those of you who practice rational expectations, here's Lucas explaining why he first brought it in, the basis being it was an alternative for presuming people could accurately predict the rate of inflation. That's what rational means according to the literature. Risk, well, that's the standard deviation of return around the expected mean. And of course you're assumed to agree on what all those values are. And of course uncertainty, well, that's certainty with risk, or it can be expected value, or it can be what de Breuil says, certainty without risk. Because if you take a look in de Breuil's paper from which we got the Arrow-de Breuil model, his definition of a contingent commodity, he said, gets us a theory of uncertainty free of any probability concept and formally identical with the theory of certainty. And we wonder, we have to hide to accuse other people of being financially illiterate. Well, it's no wonder with that as our background that we completely failed, with a few exceptions, and I'm one of them, to see the crisis coming. And I found this lovely cartoon from The Economist about the state of the markets, saying it's going to have a fairy tale ending. Well, the fairy tale is, of course, Humpty Dumpty, and there's no more appropriate fairy tale. That's what happened to the CPI in the Dow Jones and CPI deflated terms over the last decade. We're still a long way from getting back off the wall we fell down. And if you look at the literature, the people who pushed this stupid theory on us are now the ones who are saying we should disown it. It's about time we followed the lead of the people who led us up the garden path and have been the first one, not the first ones to realise, but have finally admitted that it's totally fallacious. So in my opinion, both neoclassical macroeconomics and neoclassical finance have to go. Now, an essential part of what these theories do is push money neutrality, and that means there's no role for debt in macroeconomics, and there's a barter mode of model of capitalism, which would be true if we lived in the New Guinea highlands, if it doesn't work too well on Wall Street. And has debt financing is argued to have no impact on the value of the firm, and we have an equilibrium analysis of finance. That's all nonsense in the credit-based world in which we live. We need an integrated theory of economics and finance instead, and we need uncertainty-aware subjects in finance. Now, on this basis, I'm arguing, I'm pushing again in my second edition of my book, Debunking Economics, almost all of neoclassical theory is false. The one thing it's done successfully is to prove that everything in the classical school, by the way, the theory of value, is sensible. And it commits the fallacy of strong reductionism. Our micro and our finance both try to reduce the analysis of an entire market to the behaviour of a single utility maximising individual. And that fails the test of strong reductionism. Now, a huge number of things we take for granted as true are false in the world in which we live. Walras' law, for example, works in a barter economy, but it's false in a credit one. In a barter economy, the sum of all excess demands is zero, and aggregate demand is aggregate supply, which is the model we still teach in macro, and savings create loans. But in the credit economy, the sum of all excess demands equals the change in debt. And aggregate demand is therefore aggregate supply plus the change in debt. Loans create deposits in this world, the money supply is endogenous, and out of all that, change in debt is the major factor driving asset bubbles. And the thing we've told students not to worry about, the level of debt, is actually what's caused the artificial returns on the stock market in the last 40 years. Now, the profession continues to ignore the sense of people who analyse debt sensibly, like Irving Fisher, not the Irving Fisher before 1929, but the Irving Fisher of 1932 and afterwards. And here's Bernanke explaining why he didn't take Fisher's theory seriously, and saying that it would take implausibly large differences in the propensities to consume to explain why a debt deflation could have any impact. That was 2000. This is Krugman in 2010, and initially points out that we should be taking debt seriously in macroeconomics, points out that he doesn't do it until this current paper, but then goes back to the same a priori nonsense that the overall level of debt and therefore the change in that debt doesn't matter. Now that is a fallacy, and it comes from this idea of savings create loans, which we still teach to our students 40 to 50 years after it was empirically falsified. The idea being we have a patient individual who transfers some money over to an impatient one, so patient spending goes down, impatience goes up, and there's no change in aggregate demand, and you can ignore banks. That's still the sort of macro and finance we teach today. The actual process is rather more like this. An entrepreneur approaches a bank, the bank grants a loan and simultaneously creates the deposit, and the whole idea of the money multiplier falls over as the Federal Reserve realised back in the 1960s, and I wish we'd follow this guy's lead rather than Greenspan's. In the real world, banks extend credit, create deposits in the process, and look for the reserves later. And that's the world we actually live in, and we should model it. Now that new loan creates new spending power, so the change in debt adds to aggregate demand. And to go through that empirically, if aggregate demand is income plus the change in debt, and then that is then spent on GDP plus net asset sales, where net asset sales are the price of assets times the fraction sold times the quantity, then we can say the change in aggregate demand will be the change in GDP plus the acceleration in debt. And therefore there's a relationship between the acceleration of debt and change in asset prices and change in economic activity. So you get an entwined mixture of finance and economics. And what I call the credit accelerator, which is that acceleration in debt divided by GDP, can be correlated with change in output, change in employment, and change in asset prices. Now, empirically, what we're living in is the world's biggest financial bubble, the largest debt bubble in history. That's the ratio of private debt, not public, private debt to GDP in America. You can see that our current peak far exceeds the peak back in the 1930s. It was itself largely caused by deflation. And the change in private debt drives both the booms and the busts. This is looking at change in debt versus unemployment in the 1930s. I've turned the unemployment upside down to make the correlation more visually obvious. The R squared back then between change in debt and the unemployment rate was minus 0.79. It's now minus 0.96. Anybody who thinks the change in debt doesn't have any empirical sense has to explain those numbers. Now, we've got big differences between then and now, as well as pulling out similarities. We have a bigger debt-driven boom now than then. Business is less indebted now than it was back in the Great Depression, which means we've got actually consumers who have to delever more so than households. The government response was much larger, but then there's been a faster turnaround in private debt as well, which is why that recent boom appeared to occur. But when you take a look at it, the same causal factors are there. The credit accelerator, that acceleration in debt, is what's driving unemployment, both then and now. And I'm correlating a second order change with the first order here and getting R squareds that should make anybody stand up and take notice out of those correlations over 20 years of economic performance in both instances. Now, the recent turnaround in American economic activity, which is now going back the other way, is really because of an acceleration of debt as the level of debt was reduced. Simply a slowdown in the rate of reduction of debt is what's caused an apparent turnaround, mainly, of course, in the share market. And again, you can find correlations between the behaviour of the share market and the credit accelerator in the Great Depression and now. So what we've got is a complex, unstable system. And to understand that, we need to combine monetary economics, not the stuff we currently practice. I'm trying to start developing that now, and it's based on the foundations which we didn't have mentioned today. The list of famous authors we saw come up beforehand had Keynes, but it didn't have Marx, Keynes, Schumpeter or Minsky. And I think those are the line finance should be following, plus what's come out of what's called the circuit theory in Europe and complexity theory, which again was missing in our discussion so far. Now, the starting point of all this is that all demand is monetary, and money creation occurs simply by double entry bookkeeping. And I've found that it's easy to simulate that by borrowing double entry bookkeeping from accountants and building a simple model of money creation by starting with a set of flows like this, where I've got lending from reserves to firms, recording the loan, interest payments, etc., simply shown in a symbolic table. And I can then derive a set of differential equations describing those financial dynamics, which are the simple set of substitutions, in this case a linear model to show you what's involved. You've now got a complex monetary model of demand coming out of that. And I'm also working on building a simple GUI program to make it possible even for your undergraduate students to do this. And I've recently got an INET grant to produce a professional version of that. So that particular simulation I've just shown you a moment ago is a linear one. With a non-linear simulation, as I show in a paper turning up in GBO later this year, I hope, I can simulate what was called the Great Moderation and also what we're now calling the Great Recession, with a combined monetary and finance model. Now, what do I see coming out of academic finance in the future? It's no longer a separate discipline. It should have an ancillary role for discussing the structure of markets, investment decision under uncertainty, which it currently doesn't do, and the history of financial crises. Because if we do it again, if we forget again, we'll live through it again. And for those who don't know their empirical data on the level of private debt in the Australian and American economies, that's the pattern in private debt from 1860 to now in Australia. And if you can't tell that we're in the biggest bubble in all time, and the same for the Americans. So we're fiddling away while we're living in the biggest financial bubble in human history. Now ultimately I think the finance sector has to fall to 1/4 to 1/6 the size it currently is. Because that's what I see as the desirable range of debt to GDP for the American and Australian economies. That's where we are now, and this is where we're headed. And that deleveraging is going to go on for an extremely long time because we're going from the highest level of debt we've ever accumulated in history. Now, a lot of people are looking at behavioural finance as an alternative. I see it as reasonable, it's a useful guide, but as usual in the literature, we've made a mistake in reading the original writings on the topic, because the standard practice is subjective probability. Here are the odds of what you're going to get in a one-off roll of the dice. What's your decision? Whereas von Neumann said we should be looking at objective probability, and what he was trying to do was build a numerical alternative to get rid of indifference curves, which he hated. And that's been missed not just by the people who practiced expected value theory, but also the behavioural school, because if you actually do the things the way von Neumann said to do it, all the so-called paradoxes of behavioural economics and finance evaporate. Bounded rationality I see as sensible, but it's a very unlikely foundation to build a coherent macroeconomics from. And I'd rather work in a top-down sense of starting from the overall dynamics system style and work out the behaviour from that point of view and add multi-agent modelling on to the end as a juxtaposition to what we can learn from a systems dynamic analysis of the economy. I've also heard no mention of complexity or chaos theory or econophysics so far today, and I see those as far more important. And they're actually the far better explanation for why you can't beat the market than the nonsense of arguing the market is efficient. There's a few references, there are many, many more. If you haven't yet taken a look at work in econophysics, I suggest you do. And technically we should be teaching the mathematics of dynamics, which is differential equations and systems analysis, not the mathematics of equilibrium, which is all we've been doing. Finally, for analysing investment, do it by analysing investment under uncertainty. Now Blatt showed long ago that what we call sophisticated net present value calculations because it takes into account the time value of money, and we deride payback as unsophisticated. That's the formula for net present value, that's the formula Blatt derives for the payback, where that particular component includes the investment horizon of firms. And it's yet another reason why the payback period will mean why finance has economic effects, because the payback period is pro-cyclical. So we need a new economics and finance. And to give you some resources there's a poster up on the wall and a few leaflets lying around about my book, Debunking Economics, which is almost all the economics you didn't get taught at university and should have got taught. I have a blog on the topic where I give an explanation for the crisis based on the work of Hyman Minsky. And that free software package I showed you a moment ago, still running in the background here, can be downloaded, and I'm developing a professional version. There's also a Mathematica version which is being developed by the programmer's name who you can see there. He's available for anybody else looking for work in Mathematica programming. And as you can download the prototype, and also lectures on the history of economic thought, because as much as we need to base ourselves on what's gone in the past, It's what we've ignored from the past we have to focus on. And that's the work of the classical economists, not the neoclassical. Thank you.
I'm sure you'll agree that was a very interesting and stimulating talk and for an economist.
I'll accept that.
But the next speaker is Anna Colour, and we'll have the same set of rules.
You wanted 20 minutes, mate.
You did well.
I'm going to stop the recording now.